Hey everyone, welcome back to We Are Cosmic, the channel where we break down everything happening in the crypto world in a way that actually makes sense. If you're holding XRP or thinking about getting into crypto, you're in the right place. Today, we're going to dive into something huge, something that could completely change the way banks, investors, and even everyday people think about XRP. And trust me, this is not your usual price prediction video. This is about real financial infrastructure, the kind that moves trillions of dollars behind the scenes, and why XRP might just be at the center of it all. Most people are watching the charts waiting for XRP to hit a new all-time high, but here's the kicker. The world's biggest banks aren't waiting for the price, they're waiting for something far bigger, something called the Clarity Act of 2026. Now, you might be wondering, what's that and why should I care? Well, this isn't just another government bill. This is the moment when the United States could officially make XRP a core part of the American banking system. And if that happens, the math says the price isn't just going to rise, it could skyrocket. Let me break it down for you. Ripple's CEO, Brad Garlinghouse, has publicly signaled a 90% chance that the Clarity Act will pass within weeks. That's huge. We're not talking about winning a court case or small regulatory wins anymore. This is about erasing the old stigma that made banks hesitant to touch XRP. For years, banks have been sitting on the sidelines, afraid of regulatory risks, watching XRP from afar, but with this new legislation, that fear could vanish almost overnight. Think about it like this. Banks are the lifeblood of global money. Every day they move billions of dollars through complex systems like Fedwire and SWIFT. Until now, XRP was a speculative asset for retail traders, something fun to trade, but too risky for big financial institutions. But the Clarity Act changes the rules. It provides a safe harbor that allows banks to use XRP as a standard financial tool. Suddenly, XRP stops being just a coin you buy and sell. It becomes the plumbing that moves money behind the scenes, faster than ever before. Here's another key point. This isn't about hype on social media or short-term price pumps. Institutional adoption is completely different. Banks don't care about memes or Twitter trends. They care about liquidity, speed, and compliance. They want a system that allows them to transfer massive amounts of money instantly without getting stuck in old, slow processes. And XRP is perfectly positioned to do that. So if you're holding XRP, this is the moment to pay attention. The window for retail investors to get ahead of the big banks is closing fast. By the time April 2026 rolls around, the real volume of XRP won't come from traders watching charts. It'll come from institutions moving billions behind the scenes. This is a completely new era. The old rules don't apply. Before we go any further, I want to ask you, are you ready to understand XRP, not just as a coin, but as a critical part of the financial system? If so, stay tuned, because over the next few minutes, I'll explain how this transition works, why the price might behave very differently than we've ever seen, and how you can position yourself to make sense of this new reality. So sit tight, hit that like button if you want more clear crypto insights, and let's break down why XRP could be the cornerstone of the future banking system, and why this matters more than just another price spike. Now that we understand why XRP is no longer just a coin for retail traders, let's take a closer look at the Clarity Act of 2026 and why it's such a game changer. For years, the US market was the one place where banks hesitated. Without clear regulations, using XRP felt like walking through a minefield. One wrong step, and a bank could face regulatory penalties, lawsuits, or other complications. That fear kept the largest institutions from adopting XRP for serious operations. But the Clarity Act changes everything. The Clarity Act essentially removes the uncertainty around XRP. It officially clarifies that XRP is not an investment contract, which is legal language for saying banks can use it safely without worrying about running afoul of the law. This is a huge deal because it unlocks the doors for Tier 1 banks, the biggest financial players in the world, to integrate XRP into their core systems. Banks are no longer on the fence. They can now confidently plan pilots and full-scale adoption, knowing they have the government's stamp of approval. Imagine the impact of that. For decades, banks have relied on slow, inefficient systems to move money internationally. Legacy platforms like SWIFT and Nostro Vostro accounts require billions of dollars to sit idle just to facilitate daily transfers. XRP offers a solution, fast, low-cost settlement that reduces the need for stagnant cash. Once the Clarity Act passes, banks can adopt XRP as a bridge currency, instantly moving money between branches and subsidiaries without waiting for days. This is what we mean when we say XRP is becoming the plumbing of the financial system. It's no longer a speculative tool for traders, it's infrastructure. Think of XRP like the high-speed pipeline under a city. You don't see it, but it keeps everything flowing. The faster and more efficient that plumbing is, the more smoothly the whole system runs. And that's exactly what banks are looking for: efficiency, security, and regulatory compliance. Another important factor is the scale of adoption. Right now, only a small fraction of banks run pilot programs with XRP, but nearly 80% of Tier 1 institutions have said that regulatory clarity is the final step before moving from pilot projects to full adoption. Once the Clarity Act passes, the floodgates open. Banks will no longer be experimenting. They'll be fully integrating XRP into their daily operations. This is a structural shift. The days of retail hype driving price are over. The new driver is institutional demand. Why does this matter for XRP holders? Because institutional adoption is different from retail speculation. Banks don't care if XRP is cheap. They care about liquidity and efficiency. They need the market to handle huge transactions without collapsing prices. And here's the paradox. For XRP to function as a global bridge, its market value actually needs to be high. If a bank wants to move $10 billion and XRP is very cheap, the transaction could spike the market and make settlement expensive. At a higher value, the same transaction moves smoothly with minimal market impact. This is called the liquidity paradox, and it's one of the reasons why XRP's long-term potential is tied directly to institutional adoption, not short-term trading. Short-term. We are also starting to see banks integrate XRP into existing financial software. Giants like DXC Technology and platforms like Hogan Core are already helping banks use XRP for internal liquidity management. These platforms connect hundreds of millions of bank accounts globally, making XRP the engine behind the scenes while customers still see dollars on both ends. This integration demonstrates that XRP is no longer experimental. It is becoming part of the daily financial operations of the world's largest banks. The Clarity Act doesn't just make XRP legal, it makes it functional and necessary. Once the act passes, institutional adoption will accelerate, idle cash will be freed up, and the system will start using XRP as the backbone for international liquidity. Retail traders watching charts might not fully understand this, but the smart money, the banks, are quietly preparing to move massive amounts of value through the XRP ledger. This is the start of a new era in crypto, one that focuses on real utility, stability, and infrastructure, not speculation. Now that we understand the Clarity Act and why banks are finally ready to adopt XRP, let's talk about how XRP actually transforms the movement of money. For decades, banks have relied on nostro vostro accounts, a system where banks must hold billions of dollars in idle accounts across the world just to process domestic and cross-border transfers. This is slow, expensive, and inefficient. It's like keeping a huge warehouse of cash locked up just to make sure payments go through on time. XRP changes this entirely. By using XRP as a digital bridge, banks can instantly settle transactions across borders without needing to pre-fund accounts in multiple currencies. This means billions of dollars that were previously tied up in idle accounts can now be freed and used more productively. It's not just a small improvement, it's a massive efficiency gain. Some banks are projecting a 30% reduction in liquidity management costs simply by switching to XRP for internal settlements. That's money that can now be used for investments, lending, or expanding services. Here's another way to picture it. Imagine a river with multiple dams slowing the water. Each dam represents an old banking system or pre-funded account holding cash in place. XRP acts like a high-speed canal that bypasses these dams, allowing money to flow freely, instantly, and securely. The old system trapped capital, XRP frees it, and when banks can move billions of dollars instantly, it fundamentally changes the economics of banking. Institutional adoption isn't just about speed, it's about integration into core banking systems. Platforms like Hogan Core, which services over 300 million bank accounts globally, are already helping banks use XRP as the foundation for internal liquidity. This means that customers might still see dollars or euros, but XRP is quietly handling the high-speed settlement in the background. Banks no longer need to rely on slow, expensive clearing systems. XRP becomes the TCP IP of money, the protocol layer that moves value as efficiently as we move data online. And this isn't just theory. Banks that adopt XRP are entering a competitive arms race. Those that stick to old systems risk being priced out by competitors who can move money faster, cheaper, and with less risk. By adopting XRP, banks gain a strategic advantage in the global financial ecosystem. They save money, reduce settlement risk, and gain speed. Three things every large institution values above all else. Now, here's an important point for XRP holders. Institutional adoption creates a floor for the price. Unlike retail speculation, where prices jump up and down based on sentiment, banks generate consistent, predictable demand. Every transaction through XRP requires liquidity, meaning XRP tokens are being bought, held, and used in real-world applications. This creates a natural utility floor because the demand isn't going away. It's tied directly to the functioning of the financial system. Another key factor is the relationship between price and liquidity. A low-priced XRP can't handle massive transactions efficiently. If a bank tries to move 10 billion and XRP is too cheap, the market can't absorb that volume without huge spikes in slippage, but at a higher market price, transactions of this scale move smoothly, creating stability. This is why, for XRP to function as a global bridge, its value must actually increase, not for speculation, but out of technical necessity. Finally, XRP isn't just replacing Nostro Vostro accounts, it's creating a new standard for global liquidity. By serving as a neutral bridge for multiple currencies, it allows banks to move money quickly, cheaply, and securely. It reduces trapped capital, cuts costs, and ensures compliance with regulatory standards. And as more banks plug into the system, adoption becomes self-reinforcing. The more value flows through XRP, the more essential it becomes for every other bank to adopt it. Now that we've covered how XRP is becoming the backbone of global liquidity, let's talk about something that often confuses people: the relationship between XRP and stablecoins, specifically RLUSD. Many critics argue that stablecoins like RLUSD might replace XRP or make it unnecessary, but here's the truth: they work together, not against each other. Think of it like a car. RLUSD is the fuel, stable, predictable, and reliable. XRP is the engine, fast, powerful, and capable of moving massive loads. Banks need both to function efficiently. RLUSD provides a safe entry point for conservative institutions that want predictable value. Meanwhile, XRP acts as the high-speed engine, moving value between currencies and across borders instantly behind the scenes. This combination allows banks to enjoy the stability of a dollar-backed token while leveraging XRP's speed and efficiency. Here's why that matters. When banks move billions of dollars, the last thing they want is volatility. RLUSD gives them a neutral, stable way to park value, ensuring transactions are predictable and compliant. But to actually settle transactions instantly across different currencies, they need XRP. Without XRP, the speed, cost savings, and efficiency that we talked about in Part 3 wouldn't be possible. In other words, stablecoins handle the front end, XRP handles the engine. This synergy is already being implemented. Banks and financial institutions are integrating XRP into core systems via platforms like DXC Technology and Hogan Core, which manage millions of bank accounts globally. In this setup, a customer may deposit or withdraw dollars, but internally, XRP moves in the background to settle payments almost instantly. This is the key to understanding why XRP isn't just a trading asset. It's a utility protocol that operates at the core of modern banking. Now let's talk about another big point: efficiency gains and cost reductions. Using XRP for internal liquidity reduces the need for pre-funding accounts across the globe. Banks no longer have billions of idle dollars sitting in Nostro Vostro accounts, freeing up capital for other uses. Some banks project a 30% reduction in liquidity management costs by switching to XRP for these operations. That's huge money being saved, which also makes banks more competitive in the global market. And it gets better. This infrastructure also helps banks avoid market slippage when moving large amounts of money. If XRP were low-priced, a $10 billion transaction could spike the market, making it costly and inefficient. But at a higher XRP price, the same transfer happens smoothly. This is why institutional adoption naturally supports a higher price floor, not because banks care about speculation, but because XRP must function as a high-capacity bridge for global transactions. Here's another important insight: the dual system of RLUSD and XRP creates a resilient financial stack. RLUSD locks in predictable value, which reduces regulatory friction. XRP moves the liquidity quickly and efficiently, allowing banks to settle transactions in seconds rather than days. Together, they create a seamless pipeline for both stability and speed. This dual-layer system also encourages more banks to adopt XRP, since they can start slowly with RLUSD and gradually integrate the high-speed XRP engine. This also explains why XRP is not dependent on retail hype. Unlike meme coins or speculative tokens, its value is tied to real utility and institutional demand. Banks aren't watching Twitter trends. They're watching compliance, efficiency, and liquidity. Every transaction creates measurable demand, and as more institutions adopt the system, the XRP ledger becomes the standard for global settlement. Finally, remember this: the Clarity Act is the key that unlocks this entire ecosystem. Once passed, banks will be fully confident in using XRP alongside RLUSD. The days of XRP being just another coin are over. It's now a critical infrastructure asset powering the Internet of Value. By combining a stable entry point with a high-speed settlement engine, XRP and RLUSD together form the foundation of a modern, efficient, and compliant banking system. By now, it's clear that XRP is more than just a trading coin. It's becoming the backbone of global banking infrastructure. But there's a question that comes up often. If banks just want to move money, why does the price of XRP need to rise? The answer lies in something called the liquidity paradox. Here's how it works. Imagine a bank wants to move 10 billion between branches in different countries. If XRP is priced very low, say $1 per token, the bank would need 10 billion XRP to complete the transaction. That's almost the entire circulating supply, which would crash the market and create massive slippage. The transaction itself would become expensive and inefficient, defeating the purpose of using XRP for speed and liquidity. Now, imagine XRP is priced higher, for example, $100 per token. Suddenly, the bank only needs 100 million XRP to move the same $10 billion. That's a tiny fraction of the supply, meaning the transaction can be executed quickly, smoothly, and without disrupting the market. This is why, paradoxically, higher XRP value is not bad. It's necessary for the system to work at scale. This is very different from retail logic. Retail traders often think banks want coins to be cheap so they can buy more. In reality, institutions care about liquidity, not price per coin. They need a market that can absorb massive transactions without destabilizing itself. A higher market value allows banks to move trillions of dollars efficiently, creating a self-reinforcing demand mechanism. This is also why XRP is becoming a stable and predictable asset for institutions. As banks adopt XRP for internal liquidity, each transaction locks in demand, forming a utility floor. Unlike speculative trading, which can spike and crash prices based on sentiment, institutional demand is continuous and measurable. This predictable flow makes XRP less volatile in real-world operations and more valuable for everyone holding it long-term. Let's also connect this to the escrow system. Critics argue that Ripple's large holdings cap the price because tokens are released and dumped on the market, but data from recent years tells a different story. Most of the escrowed tokens are relocked almost immediately, and the circulating supply is being absorbed by institutional demand. In other words, supply pressure is neutralized, and as more banks adopt XRP, the system naturally supports a higher value. Here's another way to visualize it. Think of XRP as a bridge over a river. A small wooden plank can carry one person at a time, but it can't handle heavy traffic. To move a freight train, or in this case, billions of dollars, you need a large concrete bridge. Higher-priced XRP tokens act like that concrete bridge, capable of carrying massive institutional transactions without breaking the market. And it's not just about moving money faster. Higher-value XRP also reduces network friction. Fewer tokens are needed per transaction, which means less pressure on global supply and more efficient settlement. This technical efficiency directly benefits banks, reduces costs, and encourages more adoption. Finally, consider the big picture. XRP isn't just competing with other cryptocurrencies, it's integrating into the global financial system. Its adoption is measured in trillions of dollars, not billions. Every large-scale transaction reinforces its utility, creates predictable demand, and drives the structural price floor. By understanding the liquidity paradox, it becomes clear that XRP's long-term value is driven by real-world use, not hype. We've come a long way in understanding XRP, from retail speculation to institutional adoption, from Nostrovostro inefficiencies to high-speed liquidity, and from stablecoins to the liquidity paradox. Now let's look at the bigger picture, why XRP is becoming a global utility asset and what it means for the future. The key idea is this: XRP's value is no longer just determined by what someone is willing to pay on an exchange. Its value is increasingly tied to the actual movement of money through the world's banking system. The Internet of Value is not a theory. It's happening. XRP is the bridge, the engine, and the protocol layer that allows trillions of dollars to move across borders instantly. Retail traders may still focus on charts, but the real volume, the money that matters, is now flowing through institutions that rely on XRP for efficiency and compliance. One critical factor is fractional absorption. When banks adopt XRP for internal liquidity, each transaction locks in demand. Over time, this creates a price floor based on real utility, not hype. Institutional demand steadily increases while retail-driven volatility becomes less relevant. Even if XRP's price fluctuates on exchanges, the underlying demand from banks ensures long-term stability and predictable growth. Let's also consider the role of RLUSD and XRP together. Stablecoins like RLUSD act as the conservative front-end entry point, while XRP functions as the high-speed back-end engine. This dual system allows banks to maintain regulatory compliance while moving massive sums efficiently. It also encourages more institutions to adopt XRP gradually, starting with small integrations and scaling up as confidence grows. This step-by-step adoption strengthens XRP's structural role in the global financial system. Now add the Clarity Act into the mix. Once passed, it removes any lingering legal uncertainty in the U.S., unlocking the full potential for banks to integrate XRP. This is why April 2026 is such a critical milestone. By that time, we could see large-scale adoption by Tier 1 banks, significant reduction in idle capital, and the full deployment of XRP as the plumbing that moves value globally. The combination of legislation, technology, and institutional confidence creates a perfect storm for XRP's structural revaluation. From a market perspective, this means XRP's market cap could expand dramatically, independent of retail sentiment. Analysts at institutions like Standard Chartered are already projecting long-term targets around 28 by 2030 based on the growing adoption of tokenized financial infrastructure. Unlike speculative pumps, this is grounded in real-world usage, banks using XRP to move trillions of dollars efficiently, securely, and transparently. Another point to consider is the long-term utility floor. Each time an institution uses XRP for settlement, liquidity is absorbed and price pressure is reduced. Unlike other assets where supply is easily dumped, the escrowed XRP system is structured, so most tokens are relocked after release, meaning the circulating supply stays in check while institutional demand grows. This creates a self-reinforcing cycle. More usage drives predictable demand, which supports higher prices, which enables even larger transactions. Finally, preparation is key. As institutional on-ramps open and the Clarity Act comes into effect, retail holders need to think strategically. Diversifying accounts across reputable exchanges, understanding the infrastructure, and following real adoption trends, not just price charts, will determine who benefits from this new era. XRP is no longer a speculative token. It's the cornerstone of a global settlement network. To wrap up, XRP represents a paradigm shift. Its long-term value is tied to utility, not hype. Its market repricing is a structural inevitability as institutional adoption scales. And its role in the Internet of Value ensures that it's not just a cryptocurrency, it's infrastructure for the world's money. By April 2026, the world will see XRP operating not as a coin to trade, but as the engine driving real, high-speed, regulated financial flows. The question isn't if it will happen, it's whether you're ready to understand and position yourself for it. So that's the big picture. XRP is no longer just a coin. It's the future of global liquidity, and its story is only just beginning.